Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at MicroVision.
If you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to imagine a company that just, loses 86% of its revenue in a single year.
Ouch. Yeah, that's rough.
Right. And they burn through nearly $95 million in cash while watching their stock price basically get cut in half.
A classic falling knife scenario.
Exactly. But now imagine Wall Street analysts looking at that exact same burning building of a company and rating its investment thesis a 7 out of 10.
Which sounds completely wild when you first hear it.
It really does.
Yeah.
They're calling it this massive wealth-building opportunity with the potential 10x revenue multiplier next year. So today, we are completely deciphering MicroVision.
Yeah, and we really need to because it is one of the most polarizing, whiplash-inducing setups in the entire market right now.
For anyone managing a portfolio, you know that turnaround stories, that's where generational wealth can be built. But they are also the exact places where capital just goes to evaporate.
Oh, absolutely. It's a crucible.
Yeah. And this is a radical and honestly a pretty painful transition that completely hinges on a really high-stakes software pivot.
It's the ultimate Jekyll and Hyde scenario for an investor, honestly. You've got this current balance sheet that looks absolutely terrifying on paper.
Terrifying is putting it mildly.
Right, but then it's paired with forward-looking guidance that absolutely demands your attention. So if you're trying to figure out how to position yourself, like whether you're holding heavy bags right now or maybe looking for an entry point, you have to understand the mechanics behind both extremes.
You really do.
You just can't evaluate the promise of tomorrow without fundamentally understanding the aggressive, deliberate costs that they're paying today.
So let's just rip the Band-Aid off right now. Before we even touch on the wealth-building potential here, you need to understand the brutal reality of the current numbers. Because this is the elephant in the room.
Yeah, let's get into it.
In the fourth quarter of 2025, MicroVision sales were a mere $223,000.
Which is just, wow.
I know. There are single, independently owned fast food franchises that do more volume in a single quarter than this publicly traded technology company.
Yeah, a busy drive-through easily beats that.
Totally. And that is a massive, staggering drop from the $1.65 million they generated in that exact same quarter the prior year.
And, the full year picture is really just as severe. For the full year of 2025, revenue came in at just $1.21 million,
Right.
which reflects an 86.5% quarter-over-quarter growth contraction. And the crazy thing is, while the revenue essentially vanished, the spending absolutely did not.
Not at all.
Total net losses for the fiscal year hit $94.98 million.
Those numbers are just so tough to swallow. But here's a statistic that made me physically blink when I was reviewing the balance sheet.
Oh, I think I know what you're going to say.
The profit margins.
Yep, there it is.
We were looking at a negative 1,435.4% net margin.
Which is already insane.
And an operating margin of negative 12,441.7%.
12,000, yeah.
When I look at a margin deficit of 12,000%, it feels like watching a captain on a sinking ship just tossing all of his most expensive cargo overboard, tearing up the floorboards, and burning the sails just to keep the vessel from going under.
It really paints a grim picture.
Why on earth would anyone look twice at numbers this terrifying?
Well, see, when you see a negative 12,000% operating margin, your first instinct is to assume the underlying business model is fundamentally broken.
Because usually it is.
Exactly. But in this specific case, that distortion is the mathematical result of a very deliberate, highly aggressive strategy. It's almost an optical illusion of a company hitting the reset button.
An optical illusion. How so?
So the margin explodes into the negative tens of thousands because the revenue has temporarily been taken down to near zero. But meanwhile, the structural costs of heavy research and development, those remain fully funded.
Ah, okay. The denominator shrunk, but the numerator stayed huge.
Exactly. Management actually refers to this transition as LiDAR 2.0. They're intentionally pivoting away from being a purely hardware-focused company that just sells, physical sensors.
Right.
And they're transforming into a software-centric model.
So they are willingly walking away from their traditional legacy revenue streams. They're essentially turning off the faucet themselves.
Yeah, they are completely abandoning the crowded, heavily commoditized traditional automotive markets.
Because supplying basic sensors to passenger cars has just become a race to the bottom, right? in terms of pricing.
Precisely. It's a margin killer. Instead, they are leaning hard into the high-growth industrial sectors, as well as security and defense.
Oh, wow. Defense.
Yeah. They actually began initial shipments of their MOVIA L sensors back in December 2025, specifically targeting those new markets. So the revenue cratered because they are in the messy middle of this structural pivot.
The valley of death, so to speak.
Right. They are absorbing massive upfront development costs today so they can reposition the entire company for much higher margin contracts tomorrow.
I mean, I follow the business logic of a pivot. You definitely don't want to be in a race to the bottom.
Sure.
But if revenue is down over 86% and you are burning cash to the tune of $94 million a year, the obvious question you have to ask as an investor is, how are they actually financing this survival?
Which is the most important question.
Right, because if the revenue isn't there, the cash has to come from somewhere. And more importantly, how does a company bleeding this much cash manage to build any sort of competitive moat?
Well, to understand the moat, you really have to look at their recent strategic acquisitions. To build this software-centric future, Microvision went out and acquired assets from their direct competitors, Luminar and Scantinel.
Wait. I need to pause on that.
Yeah.
They are burning $94 million a year. Their revenues are at rock bottom. And your solution is to go out and buy up competitor assets.
I know, it sounds...
On the surface, that sounds like a company with a gambling problem, doubling down at the blackjack table.
It does. It sounds completely counterintuitive until you look at the actual technology they are consolidating. They are aggressively hoarding intellectual property right now.
Okay, what kind of IP?
Their entire competitive moat relies on a MEMS-based laser beam scanning IP portfolio.
MEMS, that stands for micro-electromechanical systems, right?
Exactly. So, to visualize this, think of traditional LiDAR sensors. You know those bulky, spinning, mechanical buckets you see strapped to the roofs of autonomous test cars?
Yeah, they look like little spinning sirens or something.
Yeah, and they are fragile, they're expensive, and they have all these moving parts that constantly break down. But MEMS technology allows Microvision to create solid-state sensors.
Meaning no moving parts.
Exactly. The laser scanning happens at a microscopic level on a tiny silicon chip. There are no bulky spinning parts at all.
That's a huge advantage.
It really is. This makes the sensors vastly more reliable, they scale beautifully in terms of manufacturing costs, and they offer superior depth perception across both short and long ranges, which, as you can imagine, is absolutely critical for defense and heavy industry applications.
Okay, I think I see the angle here regarding the software integration and how it actually creates that moat.
Yeah, how do you see it?
Well, if they just sell a physical solid-state sensor to an original equipment manufacturer, say like a robotics company or a defense contractor, that hardware is pretty easily replaced.
Right, hardware gets commoditized.
Exactly. The contractor can just swap Microvision out for a cheaper competitor from overseas next year. But if Microvision's sensor comes integrated with proprietary software that processes all that spatial data, interprets it, and acts as the actual brain of the machine.
And you've got them.
Right. The defense contractor has to build their entire operating system around that specific software. To rip out Microvision's LiDAR 2.0 system down the line, the contractor wouldn't just be swapping a camera. They would have to completely rewrite their own internal code.
Which nobody wants to do.
Exactly. They're basically building a digital trap.
That is the exact mechanism of a high switching cost. It transforms Microvision from a highly replaceable parts supplier into an indispensable software partner.
It's a sticky ecosystem.
Very sticky. That is the moat protecting their market share. But integrating the technology from Luminar and Scantinel to build that unified software layer requires immense capital.
Which they don't have.
Right. So in February 2026, to fund this integration, Microvision issued $43 million in senior secured convertible notes via High Trail Capital.
And this brings us right to the financial health metrics, because this is where the balance sheet gets incredibly tense.
Yeah.
They currently have a market cap of about $162.49 million. Now, their short-term current ratio is sitting at a healthy 2.7x.
Which is pretty solid.
Right. And for anyone fuzzy on that metric, it simply means they have almost 3 times the assets needed to cover their immediate short-term liabilities, so they can keep the lights on and make payroll.
For now.
Yes, for now. But, and this is a massive, but their debt-to-equity ratio is sitting at 66.2x, alongside a negative return on equity of negative 182.1%.
Those numbers are just jarring.
A 2.7x current ratio buys you a little breathing room, sure.
Yeah.
But a 66.2x debt-to-equity ratio, I mean, that is the equivalent of taking out a second mortgage on your house to fund a trip to the casino.
That's a very accurate comparison.
How does a borrowed war chest of that magnitude secure a long-term future without completely crushing the existing shareholders?
Well, the risk you are pointing out is severe, and honestly, it is the primary reason this is such a polarizing stock. That 66.2x ratio is deeply intimidating.
It's a huge red flag.
However, the $43 million lifeline via those convertible notes serves a very specific structural purpose. It defers immediate debt repayments. It basically buys them the most valuable commodity in the tech sector right now, runway. They desperately need time to finalize the integration of the Luminar and Scantinel assets before their cash reserves hit absolute zero.
But the danger of convertible notes is always dilution.
Yes.
Always. If the company struggles, the debt holders can just convert those notes into millions of new shares, completely flooding the market and wiping out the value of the shares you and I might be holding.
It's the ultimate double-edged sword.
So if you are an investor watching this transition, you have to be acutely aware of how the broader market is digesting this high-risk strategy. And spoiler alert, it is bloody.
The market utterly despises uncertainty. And right now, Microvision is basically the poster child for structural uncertainty.
Let's look at the actual price action here. We are talking about a brutal 7-day share price decline of 26.74%.
Oof.
And the one-year total shareholder return is down 50.67%. More than half of the company's market value has just been erased in 12 months.
Gone. Just vaporized.
Yep. And on March 5, 2026, D. Boral Capital officially downgraded them from a buy to a hold. Across the board, the general sentiment is firmly neutral to bearish. We are seeing wild intraday volatility and high options flow.
Which usually means gambling.
Exactly. It tells us there is heavy, short-term speculative gambling happening here rather than steady, convicted investing.
The volatility is just a symptom of the market trying to price in a binary outcome. It's either going to be the LiDAR 2.0 pivot works or they run out of cash first. There isn't really a middle ground.
But here is the specific detail that absolutely glares at me when I look at the data.
What's that?
There is zero recent insider Form 4 cluster buying. For the listener, Form 4 filings are what executives have to submit when they buy shares of their own company.
Right. It shows us if leadership believes in the vision.
Exactly. Furthermore, there is zero institutional 13F accumulation. And 13F filings show us what the massive hedge funds and the smart money are buying.
So nobody big is touching it.
Right. We have no executives buying and no institutional giants accumulating shares. If the kitchen is cooking up this revolutionary, industry-disrupting LiDAR 2.0 recipe, why aren't the chefs eating their own food?
That is the million-dollar question.
If the insiders aren't buying at these deeply depressed levels, aren't retail investors just stepping in to catch a falling knife?
Look, the lack of insider buying is a completely valid red flag, and the bear case here is incredibly strong. The risks of relying on those dilutive convertible notes are very real.
Yeah, you can't ignore them.
If there are any delays, literally any hiccups in integrating the Luminar and Scantinel technologies, that cash burn will catch up to them way before the new revenue streams wrap up.
And then it's game over.
Pretty much. That very real threat of dilution and delayed execution is exactly why D. Boral Capital stepped to the sidelines and issued that hold rating. The 50% drop in share price over the last year is just the market accurately pricing in the real risk of failure.
So the execution over the next few quarters has to be absolutely flawless, or the floor just falls out.
Completely flawless, no room for error. But you also have to look at the market mechanics currently at play. The charts right now are showing deeply psychological, heavily oversold conditions.
Interesting.
When a stock gets battered this aggressively following an earnings report, algorithmic trading and retail panic often push the share price far below its actual fundamental baseline.
So it might be artificially low.
Exactly. And while it is true that executives aren't loading up on equity right now, you really have to look at that $43 million financing from High Trail Capital through a different lens.
How so? Debt is debt, right?
Well, yes, but that financing serves as a massive proxy for institutional confidence. Think about it. High Trail Capital does not just hand over $43 million to a company burning $95 million a year without conducting exhaustive forensic due diligence on the turnaround plan.
That's a really fair point. They aren't in the business of losing money.
Right. They had to look under the hood at the Luminar and Scantinel integrations and actually determine that the technology works.
That is a fascinating way to frame it. You were saying we should follow the institutional debt, not just the insider equity. High Trail Capital is essentially betting $43 million that the bridge over this valley of death is fundamentally sound.
The financing is the bridge. The critical question for you, as the investor, is evaluating what actually lies on the other side of that bridge.
And that brings us directly to the wealth-building context. Because despite the bearish beatdown, despite the terrifying negative 12,000% margins, and despite the 50% haircut in the stock price, the overall investment thesis for Microvision is actually rating out as a 7 out of 10 for a bull case.
Which is the crazy twist in all this.
It really is. And why? Because of the forward guidance. And this is where the math gets genuinely wild. Management is projecting a massive leap to between $10 and $15 million in revenue for 2026.
Let's contextualize what a leap like that actually means for the operations of the business. Going from $1.2 million to potentially $15 million is a staggering multiplier.
It's massive.
It represents the exact inflection point, where the pivot from developing hardware to licensing integrated software actually begins to monetize.
Right, the moment the trap snaps shut.
Exactly. It means moving out of the research phase and into a phase where real purchase orders from the defense and industrial sectors are actively clearing the pipeline.
If they hit that $15 million mark, it is more than a 10x multiplier on their revenue. If they execute perfectly, the upside is massive.
It's a huge if, but yes.
Analysts currently hold a 2.50 average price target for the stock, with a range sitting between 2.0 and 3.00. And we have major catalysts on the horizon, specifically the next Q1 2026 earnings, which are expected in early June 2026.
Those earnings will be make or break.
Absolutely. Plus, there are massive macroeconomic tailwinds at play here that have nothing to do with Microvision's internal execution.
Oh, the macro environment is huge right now.
Right. We are seeing a broader sector rotation back into technology driven by anticipated interest rate cuts. When rates drop, the future cash flows of growth companies become much more valuable.
Because the cost of borrowing goes down.
Exactly. On top of that, rising global defense spending is a massive tide that directly lifts their new security and defense pivot. But as an investor looking at all this conflicting data, how should you position yourself? I mean, is this a quick, speculative flip, hoping for a sudden pop on those June earnings, or is this a long-haul commitment?
If I were to distill this entire setup into an elevator pitch for you, it is strictly Microvision is a multi-year hold.
A multi-year hold, okay.
Yeah, this is not a stock for the faint of heart, and it is absolutely not a quick speculative flip for next month's earnings report. This specific play is meant for investors who have the stomach for extreme volatility and the actual patience to wait for the production ramps to materialize over the next several years.
Because integrating acquired competitor assets takes significant time.
Lots of time.
Debugging and building a proprietary software ecosystem that defense contractors actually trust with their multi-million-dollar machinery takes time.
The timeline is long, but the leverage is incredibly high. If the macro catalysts in the defense and industrial sectors actually materialize, like if those heavy-duty contractors start locking in Microvision's LiDAR 2.0 systems as their foundational operating architecture, then the current heavily oversold technical conditions actually provide a highly leveraged entry point.
You're getting in at the bottom.
In essence, yeah, you are buying the extreme fear in the market today, but you are buying it for a multi-year run toward that 2.50 plus price target. And you're relying entirely on their strong MEMS intellectual property to maintain that competitive edge against cheaper hardware clones.
It is the ultimate test of investor conviction. You really have to look past the $223,000 quarters, ignore the terrifying margin percentages, and place a highly calculated bet on the $15 million future.
It takes a lot of nerve.
It does. But analyzing a transition this severe really makes you step back and look at the broader landscape of technology right now.
It really forces you to reevaluate where the true lasting value is actually being generated in the modern economy.
Yeah.
It is rarely in the physical materials anymore.
Which brings me to a final thought I want to leave you with today. We have talked extensively about Microvision's painful, incredibly expensive shift from selling physical hardware to selling the software that controls it.
Right.
Look back at the history of computing. Look at the evolution of smartphones, the companies that mastered the brains, the operating systems, the software ecosystems, the user interfaces. They completely swallowed the companies that only focused on manufacturing the plastic, the glass, and the physical buttons.
Oh, without a doubt. Just look at what happened to BlackBerry.
Exactly. If the future of LiDAR, industrial autonomy, and global defense relies more on intelligent, adaptable software than just the physical camera sensor itself, will the companies that master the brains of LiDAR ultimately wipe out the legacy hardware players entirely.
It's happened before.
It has. So as you monitor Microvision over the next few quarters, ask yourself, are they just burning cash to survive another day, or are they quietly positioning themselves to become the indispensable operating system of a completely new automated reality?
That is the exact metric to watch. In the automation arms race, it is no longer just about who builds the sharpest eye. It is entirely about who controls the intelligence behind it.
Thank you so much for joining us for this analysis. Remember, the market routinely rewards those who look past the surface noise, translate the terrifying metrics, and understand the actual mechanics operating underneath. Stay curious, keep learning, and we will see you next time.